You are listening to Uranium Spotlight on Tuesday, November 26, 2024. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Uranium, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, U.S. utilities are left with limited fuel options. Romania's nuclear ambitions may fall short, and Purepoint and Cameco reignite exploration at Smart Lake. Last week saw a sharp drop in uranium spot prices, slipping $4.30 from $82 to $77.70 per pound. The decline followed an initial spike triggered by Russia's ban on nuclear fuel exports, which mirrored the U.S. ban on imports. Market reactions were swift, with prices jumping $3 in a single day, only to retreat as the week unfolded. Activity started strong, with Monday's initial deal pegging the daily indicator at $81, followed by a transaction at $80 later in the day. By midweek, demand picked up, but prices continued their slide. Wednesday's 6 transactions pushed the indicator down to $79 per pound. Thursday and Friday followed suit, with offers softening further, particularly for Cameco and Uranium delivery locations. By week's end, spot prices settled at $77.70 per pound, with 18 transactions confirmed for a total of 2 million pounds of U3O8. In the term market, moderate activity continues. A U.S. utility finalized decisions for a delivery request of up to 1.5 million pounds from 2026 to 2030, while another awaits offers for deliveries spanning 2029 to 2035. Non-U.S. utilities remain in quieter discussions, reflecting concerns over production challenges and geopolitical shifts. Despite the volatility, the U.S. long-term price remains steady at $81 per pound. However, with geopolitical tensions and supply concerns in play, the next round of term offers will be closely watched. China's uranium and nuclear fuel purchases from Russia have reportedly tripled in value over the past year, highlighting a major shift in global trade flows. South Korea has also significantly ramped up its purchases of uranium from Russia. This comes as geopolitical tensions continue to reshape the uranium market, with significant implications for utilities and investors alike. In contrast, relations between the United States and Russia have taken a confrontational turn, with both countries imposing reciprocal bans on uranium trade. In May, the United States introduced an import ban on Russian uranium and nuclear fuel, albeit with waivers allowing for limited exceptions. More recently, in early November, Russia responded with an outright export ban on uranium destined to the U.S. These developments are critical given Russia's dominant role in the global nuclear fuel supply chain. As the world's largest supplier of enriched uranium, Russia provides around 40% of the nuclear fuel used in reactors worldwide. In 2023, Russia also accounted for 12% of U.S. uranium concentrate imports, not to mention an even larger share of enriched uranium supplies. The impact of these bans, therefore, cannot be overstated. Following the U.S. import ban earlier this year, American utilities have already begun reducing their reliance on Russian uranium. However, unlike utilities in China and South Korea, which have been aggressively purchasing uranium and nuclear fuel to bolster their stockpiles, U.S. utilities have yet to take similar measures. Currently, U.S. utilities are estimated to have approximately 3 years' worth of fuel in reserve, a precarious position given ongoing supply chain disruptions in the nuclear fuel cycle. 3 years of fuel may sound sufficient, but for nuclear reactor operators, this is far from ideal. Unlike other energy sources, nuclear reactors cannot afford prolonged interruptions in fuel supply. A reactor sitting idle represents a stranded investment worth billions, not to mention the broader implications for energy reliability and carbon reduction goals. Furthermore, these stockpiles are already being drawn down for refueling needs, suggesting the real buffer may be smaller than reported. The hesitation of U.S. utilities to rebuild their stockpiles seems to stem from an expectation that uranium prices will eventually retreat from current levels. However, industry experts, including John Compaglia of Sprott Asset Management, have expressed skepticism about this outlook. Compaglia points to a persistent structural supply deficit in the uranium market, driven by a lack of new mine developments and the depletion of reserves at older projects. This supply crunch is unlikely to ease in the short term, especially with demand rising from countries like China and South Korea. Adding to the complexity, geopolitical dynamics are further constraining supply. With Russian exports off the table for U.S. utilities and other global players actively securing available production, the pressure on Western suppliers is intensified. For U.S. utilities, the logical response when stockpiles dwindle will likely involve increased purchases from Canada and Australia, as well as greater reliance on Western European enrichment services. However, these shifts alone won't solve the underlying problem, a glaring need for new production to meet rising demand. For investors in uranium equities, these dynamics underscore several key themes. First, the supply-demand imbalance is structural, not cyclical, suggesting sustained upward pressure on uranium prices. Second, geopolitical risks are amplifying market volatility, creating opportunities for well-positioned producers and developers. Finally, the role of Western suppliers will become increasingly critical as they are poised to fill the gaps left by Russian supply constraints. The question for U.S. utilities and the broader market is not just where the next round of uranium will come from, but at what price. For those watching the uranium market closely, these developments signal a tightening market where strategic moves by utilities and investors alike will define the path forward. Romania recently announced plans to significantly expand its nuclear power sector with the intention of utilizing its domestic uranium reserves to fuel this growth. On paper, it sounds like a strong strategic move, leveraging local resources to drive energy independence and support low-carbon energy goals. However, there's a major challenge. Romania, like many European nations, doesn't have abundant uranium reserves. Historically, Romania's uranium resources were much more substantial. During its time within the Soviet bloc, approximately 39 million pounds of uranium were extracted and consumed, leaving the country with an estimated 14 million pounds of recoverable reserves today. For context, the United States, which operates 94 reactors, consumes about 50 million pounds of uranium concentrate annually. While Romania currently has just 2 operating reactors, even this modest fleet requires around 1 million pounds of uranium annually. Last year, Romania produced just over 169,000 pounds, highlighting a significant shortfall. To meet the needs of its current reactors, let alone any new ones, Romania would need to scale up its uranium production by more than 6 times. This is no small task, bringing a new uranium mine online in a time-sensitive process, often taking around 15 years from exploration to production. Even if Romania succeeded in ramping up production to meet current demand, its reserves would be exhausted within 14 years. And that's before accounting for an additional demand from an expanding reactor fleet. This dilemma is not unique to Romania. Countries with limited uranium resources, such as Japan, face similar constraints. While having a domestic supply of uranium is advantageous, it reduces reliance on imports and provides some level of energy security, it's unlikely to fully satisfy the long-term needs of nations investing heavily in nuclear power. Consider the typical lifespan of a nuclear reactor, between 60 and 100 years. No country is going to commit to building billion-dollar infrastructure projects only to shut them down in a decade or two due to a lack of fuel. Moreover, uranium itself represents a relatively small portion of the overall cost of running a nuclear power plant. This economic reality, combined with the need for stable and continuous fuel supply, suggests that even countries with domestic reserves will likely remain dependent on foreign uranium sources, especially as global nuclear capacity expands to meet climate goals. This highlights a key theme for uranium investors. The global supply-demand balance will continue to tighten as more countries pursue nuclear energy, while domestic resources in many regions remain limited or insufficient. As nations like Romania commit to ambitious nuclear expansion, the international uranium market stands to play an even more critical role in sustaining the industry's growth. Purepoint Uranium Group and Cameco have approved a $1.2 million drill program for the Smart Lake joint venture in the southwestern Athabasca Basin. This move marks a significant return to this high-potential property. Purepoint, as operator, leverages its expertise while benefiting from Cameco's technical and financial support, a hallmark of Purepoint's strategy of partnering with industry leaders. The program focuses on approximately 2,500 meters of diamond drilling, targeting the Grooms Lake Conductor, a largely untested area with promising geophysical indicators. Preparatory work includes a 39-kilometer transient electromagnetic survey, refining drill targets to optimize outcomes. Results from this survey will be key in guiding the drill campaign set to begin early next year. Smart Lake's potential has been clear since its 2008 exploration program, which revealed uranium mineralization in altered basement structures. Highlights include drill hole SMT-0805, which intersected 147 ppm uranium over 15.4 meters within a fault zone. Although Purepoint shifted its focus to the Hook Lake project following regional discoveries, Smart Lake's untested conductors and favorable geology kept it as a priority. Located 60 kilometers south of the historic Cluff Lake mine, Smart Lake spans nearly 10,000 hectares in a region renowned for high-grade uranium. This renewed effort underscores Purepoint's commitment to advancing exploration in the world's richest uranium district while maintaining its strong financial position. For investors, this program exemplifies Purepoint's approach to efficient, well-supported exploration in collaboration with major industry players like Cameco.
And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.